Let's look at the criticality of current assets. Some current assets are very important, particularly inventories and receivables. What are inventories? Inventories are stock of finished goods which have not been sold and are lying in our godowns. They are also work in progress and raw material which we would be stocking up. What are receivables? Receivables are money owed to us by our buyers. They're also called debtors because they have not paid at the time they bought the goods. Receivables would also include any other payment due to us. For example, any advance which we might have extended to our employees or to our vendors. Inventories are critical. Why? Because number one, they are prone to losses from pests, depreciation, and pilferage. Valuation of inventories may be fraudulently manipulated to hide losses. High level of inventories indicate that sales lack procurement. Similarly, receivables are also critical. Can the buyer pay back the amount outstanding with him? Are receivables hiding frauds and fake buyers? Are receivables making us illiquid? Illiquidity is a situation where we are not able to fulfill our own obligations. For example, we might have to make a payment to our bank on account of interest due, but since we don't have money, we are not able to pay that back. Let's look at an example. This is the profit and loss statement of Unnati Farmer Producer Company for the year 2016-17. The sales of Unnati is rupees 80 lakh. The cost can be seen here. The cost of goods sold is rupees 20 lakh. Salary is rupees 20 lakh. Interest is 5 lakh. Depreciation, admin, other expenses 5 lakh. So it would seem that Unnati is making a net profit of 30 lakh rupees. How does its balance sheet look like? Here is the balance sheet of Unnati. The level of inventories appear high at almost rupees 2 crores. Remember, sales is rupees 80 lakh. So the inventory is almost 2.5 times the annual sales. What does this imply? This implies that whatever Unnati manages to sell during 1 year, its inventories are 2.5 times that amount, or its inventories are sufficient for sales of 2.5 years. Also, the receivables are very high at 60 lakhs. This is 75% of annual sales. Having looked at these numbers, the creditors of Unnati have asked for an independent audit of the books of accounts. The independent audit has found that the real value of inventories is only rupees 99.5 lakhs, which means rupees 100 lakh of inventory has to be written off. So that comes as inventory loss in the profit and loss account. Also, 30 lakh of receivables are not receivable, are not recoverable, which means they have to be written off from our profit and loss account. As a result of these two write-offs, the independent review has determined that there is actually a loss of rupees 100 lakh. What does that do to our balance sheet? Well, as we can see, while the cash levels remain the same, the inventory levels have reduced to only rupees 99.5 lakh, the receivables have reduced to only rupees 30 lakh, while the fixed assets remain the same, the overall total assets of Unnati has gone down to rupees 140 lakhs. On the liabilities side, the borrowings remain at 90 lakh. However, instead of profit, now we have a loss of 100 lakh rupees. As a result, there is an erosion of the capital or of the equity, net equity of the company.